If I gave you 10 lakh rupees today, which ETF would you be investing in? Would it be Nifty 50, Nifty Next 50, for stability Gold ETF, for diversification International ETF, or would you divide it 1 lakh each in 10 ETFs? Well, most investors do not have an answer for this. They think it's quite complicated. It's not, they make it complicated. Well, by the end of this video, I'll be giving you a sample portfolio where the ETF allocation framework will help you to build a balanced long-term portfolio. It's not the only way that you can invest, there are many ways, but it will help you to understand how successful investors think about portfolio construction. So, stay with me till the end of this video. Well, let's have a flashback and see in part 1 how we build a successful ETF portfolio. Today, we are going to complete it. In this video, I'll show you how to build your satellite portfolio, whether ETFs are actually better than the index mutual funds. And by the end of this video, you will know exactly how to build a simple, diversified ETF portfolio that can last for decades, where you achieve all your goals. Well, let's have a quick recap. In part 1, we compared your investments to a tree, having strong roots and a strong trunk. Now, we are going to build the branches. This is where the growth actually happens. And this is also where many investors make expensive mistakes. Well, the satellite portfolio. Remember, your core portfolio consists of nearly 75 to 85% of your investments. Well, today let's talk about the 15 to 25% that is your satellite portfolio. Its purpose is not only stability, but also it is growth. Think of it as adding carefully selected opportunities without changing your entire investment strategy. Well, example, you can say mid-cap ETF, small-cap ETF, international ETF, and gold ETFs. You can also include smart beta ETF. Did you notice something? Well, they are not replacements of your core portfolio at all. Well, one common mistake in investing 100% in thematic ETFs is because they performed well recently. And I've told you, never invest with emotions. Always have a strategy. In the last video, I told about it also. Well, which one should you choose now? That's the main question. I told you in last video also, don't buy everything. Choose around 3 or 4 of them. That's more than enough. Well, do you believe that India's economy will continue growing? Then you might include the mid-cap ETF. If you want diversification, well, then international ETF is there. And if you want stability, you can go for gold ETF. Well, gold ETFs can play a very important role. Your portfolio should reflect your goals. Don't have any recommendations from any YouTube channels or any magazines, etc. Well, many beginners think that gold ETF and depth ETF give lower returns. Well, during strong bull market, that's absolutely true. But that's not their purpose. Imagine you're driving a car. Why do you wear a seat belt? Well, if an accident happens, you are not hurt. Isn't it right? Well, same way the gold and depth ETFs work. When there is a downturn, you will be safe with that. They help to reduce the volatility. They provide stability. They make it easier to stay invested when the markets become quite difficult. Remember, I told you before also, the best portfolio is not the one that gives you the highest returns. It's the one where you stay invested till your goals are achieved. I hope you remember. If you've seen part 1, you'll remember. Let me ask you something. Do you currently own gold ETFs or you invest only in equity ETFs? Write gold or equity in the comments below. I did love to know about it so that I can make my next video on that. Well, ETF versus index mutual funds. This is one of the common questions that I get. Which is better? Well, answer, it depends again on the investor and not on me at all. Well, let's compare both of them. ETF, it trades like a stock. You can buy it during market hours. Usually it has a lower expense ratio. You need a demat account. Well, index fund, they are purchased directly from the fund houses. No demat account is required. It is ideal for SIP investors and very simple for beginners to understand. Neither is universally better. Choose one that suits your investing style and your goals. Well, we'll come back now to the main topic. One of the main topic, that is the tracking error. This is one of the most ignored concepts and nobody looks at it at all. Suppose the Nifty 50 gives you a return of around 12% and your ETF is giving you 11.2%. Where did the difference go? That is known as a tracking error. A good ETF should closely follow the benchmark. Well, lower tracking error usually means very good fund management. Don't choose an ETF only because it had a highest return last year. Well, always check it closely with the index. Now we'll come to the next topic, expense ratio and liquidity. Expense ratio is the annual fee charged by the fund. Lower is generally better, but don't choose the lowest number blindly. It can lead to a lot of problems. Also check for liquidity, very important thing. Imagine you went to sell your ETF and if there are very few buyers exit, you will not be able to selling them. Well, higher trading volume generally means better liquidity. You'll have to check this also. Always check expense ratio, tracking error, and liquidity together. These three matter far more than last year's return. Well, lot of things to look, surely. What are the common ETF mistakes? Well, I told you last time also. Buying every ETF recommended by XYZ, YouTube, etc. Not doing that. Owning 10 ETFs that invest in the same companies. Don't do that. Chasing last year's winners. I've been telling it again and again. Ignoring tracking error. Ignoring liquidity. Investing without an asset allocation. Panicking during market conditions. Don't do that. Remember, simple portfolio often outperform complicated ones. Well, if you have watched both part 1 and part 2, now you will understand something many investors never learn. Successful investing isn't about finding the perfect ETF. There's no perfect ETF at all. It's about building the right portfolio, staying disciplined, and giving time and opportunity to work for you. Well, wealth is created through consistency, not constant change. Remember the question I asked you at the beginning? If I gave you rupees 10 lakhs, how would you divide it among different ETFs? Well, here's a simple example how a long-term investor might think about the allocation. Well, this is only an example. Don't think it as a model portfolio. 75% core portfolio, 50% Nifty 50, 25% Nifty next 50, 25% your satellite portfolio, 10% gold, 10% mid-cap ETF and 5% international ETF. This is only an example portfolio construction. It is not a recommendation or a model portfolio at all. Your ideal allocation depends on your financial goals, your investment horizon, your risk tolerance, and your existing investments. Well, an young investor might choose a different allocation than someone who is nearing retirement or someone who is in the middle stages. Well, what is the key takeaway? Don't copy these percentages. Well, build a portfolio with a strong core, a carefully selected satellite and a discipline to stay invested for the long term. If this two-part ETF series helped you to build a smarter portfolio, I'm conducting a masterclass every Sunday at 11 a.m. where we'll be discussing different subjects raised by the investors. So if you have any doubts regarding any investment topics, you can join for that. Well, the link is there in the description. I'm giving a WhatsApp link where if you join the Sunday, the link will be given over there. So please like and subscribe to my channel, Finance with Ajith Dinesh. This video is made for educational purpose only. Disclaimer in the description. See you in the next video. Thank you.